Thank you, Christine. Good afternoon to everyone online, and good morning to those joining us from the West. I'd like to start by acknowledging the traditional custodians of the lands on which we all meet today, and pay my respects to elders past and present and to emerging leaders. I myself am coming from Gadigal country in the Eora Nation here in Sydney. Thank you to everyone joining us today. It's the start of an exciting period of our annual cycle as we head towards renewal. We've been working hard over the last couple of months, as you would have read in CEO Connect and Member Matters, engaging with reinsurers already and looking ahead to what reinsurance coverage and pricing might look like as we head towards our renewal. Today, we are having a look at line by line where we think the market will be and any updates on the protections. This is an important part of the cycle, this webinar, so that we can support you, our members, in preparing your budgets for the year with a degree of certainty. And today really is our best view of where we think the market will be. As you know, we're still 3 months out from the renewal and at some time away, particularly in an insurance cycle, but we will give you the best indication that we can today so that you can start to prepare your budgets. I'd like to start, before I hand over to the team, just start with an important piece of work that we've recently done, and that's looking at our pricing over time. Members for the last couple of years since I joined have said it'd be really great if we could share benchmarking data or share a view of how our pricing compares to the rest of the market. So this year we've been working with Finity, who would be the insurance industry's lead actuary in this space, to come up with a view of how we think our pricing over the last decade has performed. And as you can see from this chart, pleasingly, we can show that our pricing from a movement perspective has outperformed the general insurance market. This analysis, over the softening and hardening market, does really prove that the mutual model is working. And for those who've been in the mutual over that period as a membership, have benefited from prices that have been lesser than the increases we've seen through the hard market over the last decade. So we thought it was really important to give transparency to this. And I know in engaging a couple of members on my road trip last week, a couple of members actually said that would be really helpful to risk and audit committees who generally ask the insurance function, how do we know we're getting a good deal? And I think this graph does show our competitiveness in the market. So if you do have any questions on that, we are happy to answer them. And if you'd like further detail, more than happy to work with you on that to give some transparency for your risk and audit committees or other executive. What I'd like to do now is hand over to Susie Amos from Finity Consulting. Susie's a principal with Finity, and for those who've been with us for a number of years would remember her from previous updates. We always find it really important that it's not just our view of the market, but we do have the facts behind it and an industry consultant like Finity to work with us to ensure that we are giving an accurate view of the market on behalf of ourselves to you, our members. So with that, welcome again, Susie, and I'll hand over to you.
Thanks, Jeff. Look, doing Finity Market Update is something I very much enjoy, and the market is certainly moving quite quickly over the last couple of years. So it's been the 30 June renewal has been something that I've been watching quite closely. So keen to talk about it. What I wanted to start with, though, was just sort of on a page what Finity thought might be the forecast or the outlook for the rest of the year. And so let me just describe what I've put on this single page. So I've got on the x-axis the expected rate change that we think is going to happen over the next year, and on the y-axis I've got forecasted profitability that we think the market will achieve at those particular rates. And what we can see pretty quickly, if you look at the axis, that the classes that you see on there are all in the rate reduction territory. So they're all seeing reductions in the risk-adjusted rate online, and corporate property seems to be the one that's had the most dramatic rate reduction in the last or we expect to have over the year. Certainly the 30 June, they had quite a bit of a rate reduction, and we think that will continue. In terms of financial lines and cyber, they've actually been in rate reduction territory for a couple of years now. It's probably stabilised, I guess, still reducing, but sort of not as much as corporate property. And liability is just starting to show signs of following the pack in terms of softening the market. So going to see a rate reduction, but not as dramatic as what we've seen across the other classes. Why is this happening? Well, if I draw your attention to where all those classes are sitting, or Affinity's estimate of where they're sitting in terms of the profitability, they're all sitting pretty much within target, other than liability, which is just on the border of below target. And that's really sort of driving the appetite in the market to jump in to these particular classes. So we're certainly seeing fierce competition. The profitability it's just holding up for now, but it probably won't be for too long. So if we go to the next slide, I'd like to just take you into a little bit more detail on what we're seeing in the classes, what we've seen over the last year, and then sort of put it together with what I just showed you in terms of the forecast on that previous slide. So corporate property, it has been seeing some rate reductions over the last year, but we've seen that escalate at the latest renewal, and we think that that's probably going to peak this year. You can see on the table at the top left, capacity is quite substantial, but what we have seen is a shift in profitability from the green to the orange, so above target profitability. So it's been really attractive, and that's the reason why it's become quite competitive, and we're probably seeing those rates go down. Now that's moved into sort of within target, but I probably would call out there's been a lot of favourable elements in terms of the perils environment in Australia over recent years, as well as the activity that we're seeing sort of more in large loss sort of experience. We have had quite favourable environment over the last couple of years, and I think the market sort of responded to that, but that doesn't look like it's going to continue. So I think that the class might soon be under pressure in a year's time. Going to standalone liability, it has really been the one that's sort of trailing the pack in terms of moving into that rate reduction phase, and we've only just seen it start to go into rate reductions. We think there'll be a little bit more over the year, but there's probably not a huge amount for that particular class to go, given some of the pressures that they have. And it did go from a profitable or above profitable level, but it's now moved into the within profit and probably on the border. So it's probably not going to go as soft as some of the other classes. Financial lines and cyber, they've both been on a journey and led the way in terms of the softening market for a couple of years now. You can see there that both of them have been sort of at that 10%-ish rate reduction level. That's actually been over the last couple of years, and capacity has increased materially for those particular areas. So they're definitely within appetite. There's probably been sort of surprisingly quite favourable claims experience that has led the class to be above, financial lines in particular, to be above profit, above target profit. It's moved into within target, and I think with those continued rate reductions next year, it's expected not to be within target. So in terms of that sort of softening phase, we think that cyber probably will follow a similar pathway, and there's a significant amount of appetite. So it'll probably be a similar pathway as financial lines. So just zooming out from that, we certainly see ourselves in this greater capacity and softening market. But if we go to the next slide, I'd like to just draw your attention or remind you on a little bit of the journey that we've seen in terms of the market cycle, and how I've got a few thoughts around what that means in terms of navigating the soft market that we're currently in. So if we look a little bit back at the history over the last sort of 20 odd years, we actually have seen not much of a market cycle. I've got a global rate index that I've plotted on that chart, and it doesn't show a lot of variation in the rate up until sort of the hardening that happened just before 2020, so 2018, the market started to harden in Australia. But before that, we've been pretty benign in terms of the market cycle. So that hardening that happened, and I'm sure those on the call sort of aware of that certainly sort of drew attention to insurance and the prices and the pricing, and sort of thinking about the sort of cover that that customers sort of took on. But we've now seen that the market cycle seems to be back, and we're going back into a softening phase. And I guess my expectation is that we should expect this market cycle now to be back in train, where for many years it was pretty flat. I think we should expect to see this cycle reinstigate going forward. But it really draws the attention to the market on, well, how do you navigate this soft market? Because a number of features do come out. There's reducing premium pool, there's reduced profit margins for the insurers, and that does sort of result in a lack of sustainability of the insurance market. We see a number of competitors and insurers jump into the market, but in the same period, like in possibly 5 years' time, when we expect the cycle to change, there will be some fallouts from that soft market, and we probably expect to see what we saw in 2018, which was a withdrawal of capacity coming through. So really there's that sort of question of sustainability in the soft market, and I always like to really emphasize that thinking about the through the cycle trends and through the cycle sustainability is what's important, rather than trying to play the cycle. No one's been successful in getting the timing right and playing the cycle. So navigating that soft market and really thinking about sort of a sustainable business model through the cycle is quite important. I did mention earlier, and something I wanted to cover on the next slide was just a final comment on social inflation. I mentioned that liability did have some sort of claims experience that was resulting in it not looking as profitable as some of the other classes. And that's really linked to social inflation that we're seeing in long tail classes. There's been a huge amount of discussion in recent years over the inflation from an economic point of view that hits our short tail classes. Look, that's settled down a bit now. There's a bit of uncertainty in what tariffs are going to do, so there's a question out on that. But if I draw your attention to social inflation, which really sort of links to the cost of settling litigation or other sort of long tail claims, it's something that doesn't get as much attention, but has had quite a bit of development, particularly in the US. So there's been significant deterioration from a number of players in the US, and significant increases in the cost of settling claims. So it naturally has the question of, well, what does Australian environment look like, and what could that mean to our long tail classes sustainability? When we have a look at the broader environment in Australia, we don't think we have that sort of catastrophic level that we're seeing in the US in terms of social inflation, but we are seeing a warm sort of environment of social inflation. So we are seeing increase in settlement costs, new types of claims starting to come through, and new sort of damages starting to be attached. And if if you just sort of click one more, I've got a list of the hotspots that are making their way into the environment, and we're observing over the last few years. So I might draw your attention to a couple of them that might be quite topical for members. Psychological claims is something that features quite a bit in workers' comp, and naturally it's starting to feature in liability as well. We're seeing on a regular basis that secondary psych is being attached and settlements are settling for more. So that's something that I think you can expect to be a feature ongoing and may not be properly sort of considered by current players in the market. The emerging areas, I'll just sort of call out a few. Cyber, climate litigation are probably the ones that are worth paying attention to, and seeing how some of the litigation plays out. I mean, it's really early days. There's actually been limited settlement activity, but there's certainly a number of actions sitting in Australia in that area, and it's something that's probably an area to watch in terms of where you might have exposure and ensuring sort of coverage from an insurance point of view. So I might just sum up the market update, and if we go to in terms of a wrap up, how would I characterise it? Well, it is very much well and truly in a softening phase. There's a fair bit of competition, but what I would really call out is to think about the through the cycle and a sustainable model, and what I really hope for the market is it remains rational. Not always possible, but there's sort of a rational market that prevails and ensures a sustainable outlook. So I might pass on.
Yeah, thank you, Susie. I think it was a great insight into where the current market in Australia sits, and now bringing it a bit closer to home, to the Unimutual protection update. If you move to the next slide, yeah. So if we start with a property protection, and as you know, reinsurance is an important part of our renewal process. And it allows us essentially to protect the mutual's capital and also provide a reliable and cost-effective cover to you, our members. The July 1st is a very critical day in the reinsurance cycle in general. It's the main renewal date for reinsurance covers in Australia, and gives us a first indication where the market is heading, particularly as the other critical date, 1st of January, is already 6 months out. So we keep a close eye on where the reinsurance markets are heading in Australia, as well as from a global level. And as a reminder, reinsurance is by definition almost a global risk management tool, if you like. And our reinsurance panel is a mix of international as well as Australian carriers. So the Australian as well as London conditions in particular are quite important for us. So where did July 1st end up on the reinsurance side? I think generally the favorable conditions continue. We've seen that on the 1st of January, as well as midterm renewals in April, and they definitely continue in the July renewals. What's driving these favorable conditions is mainly increased capacity, which we've seen also in our renewals over the last couple of years. Increased appetite driving increased capacity offerings for our portfolio as well. Moderate catastrophe claims in Australia as well as on a global level. At the beginning of the year, there was a bit of concern in the industry around the bushfires, particularly in California, and whether they would have any global impact from a loss perspective as well as from an exposure perspective. From a loss perspective, it was relatively maintained. From an exposure perspective, we do get a couple of questions in terms of the bushfire exposure in Australia as probably being the second country besides the US in terms of global bushfire exposure. But generally, the claims experience has been moderate to favorable in Australia, with the cat claims. I think the first 6 months sitting around 1.8 billion, which sort of needs it to the long-term average in Australia. For us, the reinsurance renewal process has now well started. So that time of the year, we're working with our reinsurance broker together to put the best information together so we can present our portfolio, the performance, the claims history, but also demonstrating the strengths of our risk management approach, and also highlight the work individual members do, particularly on the risk management side, which is really well received by the reinsurers, who are really looking for continuous risk improvement, and what do we do and what do the individual members do in that area. Again, we started presenting. If you stay, can you go back to one slide, Christine, please? So, yeah. So we have been presenting to the various reinsurers now. Very good discussions, definitely. They continue to like what we bring to the market, the quality of the portfolio, and a very good loss experience, particularly over the last couple of years. So the theme of increased capacity and increased demand in our product is definitely there, and I think that should put us in a very good position. In terms of more granular questions or comments we get from the markets at the moment is valuations. I think that's been on the cards pretty much since the high inflation years from COVID. Obviously, the markets, and we want to make sure that the members continue the good work that we've seen over the last couple of years, particularly in using valuers. And just as a reminder, we issued the valuations panel, which I think that also helps to achieve this consistency, trying to understand better where our value changes are made up, where do they come from. Natural catastrophe exposure, bushfires I mentioned before, driven by the international loss experience, particularly in the US, and at the moment Europe is, I won't say Europe is on fire, but there's quite a few bushfires, particularly in southern Europe, which sort of highlights the climate change element almost to it. Claims history, obviously the markets are very, they like to see the good performance over the last couple of years, but also worry that any deterioration in prior years' losses are under control. 2 years ago, we started the focus on high value equipment, which is something that's very well received. And I think the effort the members do at working with Simon and his team on taking stock of the high value equipment and work with them in terms of what does risk management look like is great. Risk recommendation, and here it's really about, it's not set and forget, it's the continuous improvement in terms of prior years risk recommendations to weave them into the work, and they're not forgotten. If you move on to the next one, the property protection. So what changes do we from a product? We have the technical committee, which pretty much a couple of members are there, going to talk to technical issues, but also provide valuable feedback to the underwriting team in terms of product improvement, product enhancements, general feedback, where it's normally just a loss comes up and we figure out areas could be improved. So this year we continue to update the wording. There's a couple of minor changes, mainly I would say cosmetic or clarification. One of the bigger changes is probably the increase in the R&D limit under Section 2. Which will now be significantly increased as we move it into the item 1, the general revenue item. So essentially, there's no differentiation between R&D and general revenue, so we can put that now under one limit, which would provide significantly more R&D limit available to the members. Clarification of crop, that was something a member brought up, and it's really about having a clarification where does particularly crop sit in a controlled environment as part of a research and development project, and what cover is available. So we really now have the clear distinction between Section 1, Section 3, and also on the exclusion side to mirror what's pretty much the market standard, that growing crop is only covered for fire, lightning, and explosion, as long as it's outside a controlled environment. The last point here, a move from accidental damage to unspecified damage. That was really a feedback from some market carriers that the more there's certain aspects on the accidental damage definition that could provide some are less clear, to put it that way, and to move to a market term that's unspecified damage. The actual definition, what perils are covered under unspecified damage, or the other way around, what perils are excluded, stays exactly the same. It's just to provide this change in terminology from accidental damage to unspecified damage. And the last one, unproductive salaries and wages, again, something from in Section 2, where we just took some member feedback on board and provide some more clarity. If you could move to the next slide. So moving closer to the actual renewal, and in terms of what's important, obviously accuracy and timeliness of valuations remains critical. One area which we want to mention, we've seen a couple of examples in the membership, particularly when valuers change, that values can move quite a bit, and it's really to understand where changes in values come from. Does it come from new asset, different assumptions, different values, use a different approach? So that's absolutely critical for us to put our portfolio in the best perspective for our reinsurance renewal, and also provide you with the best terms. Continuous improvement in risk management. It's something, there's almost a bucket of traditional risk management items which we like to see addressed, but also the response to emerging issues, things like EV charging stations, which I think Simon's done a great work with the new guidelines coming up. So it's either emerging climate change related risks. So just be aware of the emerging risk space, and take those feedback from the surveys on board and the publications we put out. Just as a reminder, when we move closer to the contributions, and as Jeff mentioned, the main purpose, or one of the main purpose of this webinar today, is to provide some guidance on where the renewal could head. Just as a reminder, the contribution changes have various input factors. The main ones are probably here general value updates. I mentioned above the importance of the accuracy and timeliness of the values, but also new assets. Obviously, if you add new assets, it sort of comes on top of the general value updates, which are more inflationary. The data quality, and that's really the granularity of the data helps us to do the risk modeling to the best possible outcome. Obviously, the loss history and recent claims impact the rating, as well as the general rate change, and obviously our cost base, and particularly there what the reinsurance does. In terms of where that means from, and let's call it here rate reduction. So we do see rate reductions coming towards the membership, probably in the area of -2.5% to 12.5% reduction at this stage, which is something we always want to be rather cautious at this time of the year. So, but that's sort of between 2.5% and 12.5%. That's probably the range we can see it's heading at the moment. One area we want to address at renewal is we received more and more requests for retention changes. So this year we'll provide a number of standard retentions at renewal as part of your quote. So that gives you some guidance what the impact of certain retention changes on the contributions will be. And lastly, on this slide, the active assailant, which is one of the products which also showed increased interest in the membership over the last couple of years. Just as a reminder, it's a $2 million standard limit for every member. Some members, particularly larger members, ask for, can we get more, particularly on use of active assailant events in Australia as well as on a global basis. So this year we'll be providing an automatic increased limit up to $4 million at additional contribution, but that will be part of the standard renewal quote this year. And lastly, on the fine arts side, we'll also have sort of some improvements, particularly around unnamed locations and new additions, which will flow through into the updated wording. So again, to respond to some members will say, yeah, we've seen in the open market certain areas where the product could probably be enhanced, and we addressed that within Unimutual as well as with our reinsurance partners, and they were more happy to meet those requirements from our side. And with that, I hand over to Jade. So Jade Wahlen joined us at the beginning of June, and as a new casualty underwriter. And once the first couple of weeks were quite a whirlwind join. Welcome to Unimutual, but been a great addition to the team, to the underwriting team, and particularly pleased to have Jade on board ahead of the renewal, so that we can hopefully provide the best terms and answer all inquiries as they come up. With that, I hand over to Jade.
Thanks, Tobias. Thank you very much for that very warm welcome. Hello all. As Tobias said, I'm Jade Wahlen, the new Casualty Underwriter. I joined the team here in early June, and I look forward to connecting with you all over the next few months as we head into the renewal. I'm going to spend some time over the next few slides just talking through our suite of casualty protections, and beginning here with the combined liability. Our combined liability product provides comprehensive protection across 4 key sections, being general products liability, professional liability, medical malpractice, and clinical trials. For this year, there's no material coverage changes anticipated this year, and in the wording changes that we're proposing are also cosmetic, with a focus on providing clear definitions and consistent interpretation of key terms throughout the wording. The coronavirus exclusion is to remain unchanged from the current wording, and the same goes for the cyber and data exclusion. That was also expected to remain as expiry. We are currently in negotiations with our reinsurance partners to maintain the coverage at $10 million per member for sexual molestation cover, which is consistent with the expiring terms. And we just wanted to sort of highlight here that accurate and detailed data collection remains critical. It really supports more effective risk underwriting and enables us to continuously refine our risk-based pricing model, ensuring that there's fairness and sustainability for the membership. It's a little bit too early to provide precise guiding on renewal contributions. However, as Susie noted in her slides earlier, the current rating environment varies by class. The general public liability market is experiencing slight rate reductions, while the med-mal and clinical trials market are seeing slight increases due to medical inflation outpacing general inflation in Australia. Although the professional lines markets benefited from substantial rate decreases in recent years, the pace of that is starting to slow down. So taking these factors into account, our current outlook for the most members can expect contributions to remain flat or decrease by about 5 to 7.5%, subject to own individual loss and claims history. We're just going to move on now to management liability. Our management liability product is an insurance product that's offered by Chubb, and it's facilitated through Unimutual for our members. It covers directors and officers, employment practices liability, crime and kidnap, and ransom and extortion. As part of our ongoing commitment to members, we're actively exploring market options to ensure we continue to provide the best possible product for our members. The management liability insurer is currently conducting their actuarial analysis for the upcoming renewal. So while it's too early to comment on pricing, our objective is to secure cost savings for our members. along with enhancements to the policy wording, ensuring that we continue to offer the best and the broadest management liability coverage in the market. There's no expected changes to the limit of liability, sublimits and deductibles currently being offered, and all current endorsements will remain as expiry. Onto cyber. The updated Unimutual protection, which we released in 2023, includes several coverage enhancements such as contingent business interruption, system failure, betterment and bricking, ensuring that it remains a market-leading protection. The intention for this renewal is that the limit in liability and retention is to remain unchanged. At the last renewal, we also introduced a pre-loss service discounted pre-loss service as an added value for the members, and this offering will continue into 2025. But with that, we're also actively exploring additional value-add opportunities in collaboration with our reinsurance partners to offer to the members. During the past year, the crisis management provider was changed from Clyde & Clow to Atmos, and as part of the service, Atmos is offering onboarding sessions to all members with cyber protection, ensuring that you're well prepared and fully understand the steps in the event of a cyber incident. Early containment is critical to managing claims outcomes, which is why early claim notification remains a priority to help protect members from significant pricing volatility. While it's too early to provide definite guidance on renewal pricing, we anticipate that our reinsurance partners will again be placing strong emphasis on assessing IT security controls. So with that, each member will be individually underwritten with contributions determined based on the outcome of that assessment. Our current outlook suggests that, subject to individual claims history and experience, most members can expect to see reductions flow through this year. Now finally on to pandemic. Pandemic was a new protection introduced to members in 2024. This is a parametric solution designed to cover non-damage business interruption losses. It provides financial support for losses such as gross profit, bank interest payments, fixed rent, wage roll, etc. So the product is triggered when 3 predefined conditions are met, and unlike traditional indemnity-based coverage, this structure allows for a fast cash injection and faster claim settlement process, helping you manage expenses quickly during a crisis. Some key product enhancements for this year is the removal of the SARS-CoV-2 exclusion, which means that the policy will now potentially cover all known and unknown coronaviruses, provided that all the triggers are met. And so with the triggers, we're working on developing with our reinsurance partners and exploring alternative trigger mechanisms to further enhance the protection offering. As part of this year's renewal, members will be offered a number of automatic coverage options up to 5 million, but we also have the capacity to quote limits up to 200 million on an individual referral basis, should the larger limits be of interest. Members will receive early indicative pricing from us, and detailed information from the team will come out next week. So thank you. That's all from me, and I'll pass over to Christine.
Hi, thanks, Jade. Thanks very much for that. So I'm just going to take you through our next steps. So we've, as you know, data collection is due for completion on the 31st of July. And thank you to all our members who have done an amazing job of getting this all completed. We're in a really good place at the moment in terms of completion status, with a few bits and pieces left to go. But this year it's been a really tremendous effort from all the members to get in there and complete the data collection information. Just to remind all members, once you've completed your data collection, we will PDF all the data collection forms into a single document, and we'll have that available for you to download in the documents area in Resure. We'll also have available in Resure the data collection declaration form, which needs to be signed off and completed, and we'll advise you when the documents are available for you to access. Our aim is to have renewal quotations available from the 7th of October, and we'll be undertaking our renewal presentations with each of our members at that time. Members are required to confirm their acceptance of the quotation and their preferred options by the 27th of October. Once you've accepted the quotation, we can then issue the confirmation of protections at that time, and the offer of membership and membership declaration is issued for final sign-off. The certificate of entry and tax invoices are issued on the 1st of November, and all contributions are due for payment by the 30th of November.